there, FSGO speaking here. Today's chapter will be discussing money management. This is one of the most important chapters and I need you guys to take out some books or notes, and without any further waste of time, let's get started. When trading Forex, getting the right direction of the trade is only one side of the coin. Money management is on the other side. Even the best trades and the most profitable trading strategies won't do much if you don't have strict money management rules in place to protect your winning trades, cut your losses, and grow your account. So basically what I mean here, guys, is that money management is a key to success if you want to venture into the business of Forex trading. Why? Because one of the wealthiest traders in the world, George Soros, applies strict money management rules and is also known as the man who broke the Bank of England. So I always tell many people that, guys, if you want to become a professional trader, you are supposed to learn from someone who is a professional trader or striving to become a professional trader, because you need to learn the proper ways of how to approach the Forex industry or the Forex market. Money management refers to a set of rules that help you maximize your profits, minimize your losses, and grow your trading account. The reason I'm going into depth to explain money management is because beginners in Forex tend to neglect even basic money management rules and end up blowing their accounts over and over again. Why? Because they do not understand that without proper money management, you can't become a profitable trader. Reason being is that no money management means no money. If you can manage or handle your money, that means you lose all your money. Hence, I'm saying money management is a key to success if you want to venture into the Forex trading business. Okay, now let me give an example of what I mean by that. We have two traders. The first trader has an awesome trading strategy that is profitable 90% of the time, but doesn't manage the risk at all. And then the second trader has an average trading strategy with 50% winning rate, but utilizes top-notch money management rules. As you can see here, we have different types of traders. The first trader has the best strategy, but don't know when or how to apply money management. And the second trader has 50% winning rate strategy, but knows when to apply his money management rules. So now, what do you think? Which trader will end up with more profits by the end of the month? And hence, obviously, the answer will be the second trader. Why? Because the first trader will likely lose all of their profits and perhaps even more on a single losing trade. This is why I say Forex money management helps a lot to succeed in Forex trading. Like I said before, if you can handle or manage your money, you will lose all your money. Money management is a key to success if you want to venture into the Forex trading business. Okay, so let's finally dive into exactly what are the money management rules that I'm talking about. The first one is cut your losses short and let profits run. What I mean is that this refers to a straightforward principle. When a trade is losing, close the trade before the losses accumulate, and when a trade is performing good, leave the trade open and put stop loss above entry, then let it hit take profit. For those who've been following us or our previous videos before, you know that we're always emphasizing to always cutting your losses short and then letting profits run. Why? Because inexperienced traders do it is the other way around. They leave losing trades open in the hope that they will eventually reverse, and they close a profitable trade too soon on fears that the trade will turn against them and become a losing one. Fear and greed are one of the most disastrous emotions in trading. You need to learn how to control them early in your trading career. The most profitable traders do it the professional way. Why? Because the day you don't cut your losses short, that loss will eventually become your last loss for your trading account. Let me show you an example of what I mean by that. I'll start with illustrating. Let's say, for instance, you've been winning and losing some losses, and then one day you decide to not put a stop loss, and then that trade goes against you until it ultimately blows your account. So we're trying to prevent such here. Let me show you such a case in an actual market. Let's say, for instance, we're in the actual market here, and knowing how to trade, you know that we always buy low. We're always looking for buyers in low opportunities, right? Now, knowing that you always bought low, and then finally you see that the market pushed and broke your uptrending resistance, and then at this point right here, you're looking for a reversal and a continuation of an uptrend. Why? Because this is now your support structure and no longer your resistance. And then this time you enter without having a stop loss. You have only a TP, and then what happened was that loss finally dropped without having a stop loss. You're hoping that it will reverse, it continues going down, and then you're still hoping for it to come back. You still don't close. You are now excited, thinking that's going to finally go back to your direction, and that loss finally goes down and then blows your account. Hence I'm saying, guys, it's important for you to apply money management rules because you don't know when this will happen. Hence I'm saying never enter a trade without having a stop loss, because this is the ratio you put into your market. You're saying you can afford, you have a TP, you can afford to win this, but you are affording to lose this much. How is this a winning ratio? So be careful, guys. Money management rules are very important and you must know when to apply them and then how to apply them. Okay, now let's continue with the slides. On our rules, we secondly have don't chase the market. New traders on the forex market usually chase the market for trading opportunities and trade even on low probability setups, ultimately ending up with many losses. Excited by the market and their first trading account, beginners will open multiple trades in a single hour, hoping for a great profit by the end of the day. Unfortunately, this behavior resembles more of a gambler than a trader. Why? Because you shouldn't trade every day, because if you don't see your setup on that day, don't trade. You can trade every day if you see your trading setups every day. Do not enter a trade without analyzing. Do not enter a trade with hoping that it will go into your direction. Enter a trade having a stop loss, seeing that it's a high probability that it will go into your profits. So that's basically how you should know when to enter a trade. The market doesn't owe you anything. With experience, you learn that patience is a key psychological trait that makes you a great trader. You don't have to open a new trade every hour or even every day. If there are no trading opportunities, I step aside and let the market come to me. And in the next few days, when a high probability setup arises, that's when you trade. For those who are in our live signals group, they always see that is our free signals group. They always see that I only send trades when I have my higher probability setups. Only trade when you have leverage over the market. That's basically how you win in forex trading. Okay, so now let's go to the last chapter of rules, the last one being risk per trade. This is basically the key factor of risk management. Risk management goes hand in hand with money management because you must learn how to manage your money and also how to risk with your money. Okay, so now let's continue. Risk per trade refers to the maximum amount of risk you're taking per any single trade. Risk per trade is usually determined on the percentage of a trading account size. I always tell my people, if you want to trade forex, you must always ask yourself, what is your account size? Do not want to have a loss size of a $10,000 account if you have a $50 account. You should know when to apply a risk of your current account size. Okay, let's say that you have a $10,000 account. You open a trade with a potential loss of 2,000. That's the maximum loss if the trade hits your stop loss. Then that means your risk per trade would be equal to 20%. That example shows you how not to trade. That is a bad way of risking. You should never risk 20% of a trading account, especially if your account is that big. Why? Because taking a 20% risk per trade is way too much risk. As a strike of 5 losing trades would wipe out your entire account. Even 2 losing trades would leave you with only 60% of your initial trading account size. And guess what? It takes much more than 40% to return to your initial account size of 10,000. It's very important, guys, for you to know the power of risk management. Forex trading is actually the least riskiest business in the world, provided that you know how to trade and not how to gamble. If you only risk a small amount of your account size, you are affording to lose small but actually win big. Why? Because the golden rule is to have a risk per trade not larger than 2 or 3% of your trading account size, and also not 1%, because that is too low of a risk for you to make your trading worth it. If that's the case, then you should trade on your demo account instead. That will be all for me today. Hope you enjoyed this lesson. FS Goats signing out. We want to thank you guys for making it to the end of the video. We appreciate the love and support. So what we try to do is FS Goals. We try to teach people how to trade Forex the proper way and not turn them into professional signal seekers. So far, we've been getting results from you guys. Those are working hard. We appreciate it a lot. And it encourages us to actually bring out more content. Yeah. So that's all from us, guys. I hope you liked the video. Don't forget to share it. FS Goals.